There have been worries about the level of Canadian consumer debt. Credit card delinquencies have been growing, according to Equifax. That was in a report in December. And as of late last year, overall consumer debt rose to about $2.4 trillion. So are we seeing more insolvencies? Let's turn now to Benjamin Tal, Deputy Chief Economist at CIBC. It's great to see you, Benjamin. So delinquencies are rising, but from a pretty low level?
Exactly. So first of all, we see a situation in which overall household credit is now, in inflation-adjusted basis, zero. We haven't seen it before. Even the 91 recession, it was positive. So this is the lowest on record when it comes to real increase in household credit. Now, why? First of all, we see some decline in limits, but the most significant story is actually lower utilization rate. Basically, consumers are saying, you know what, thanks, but no thanks. Enough is enough. Interest rates are too high. I have my limits. I'm not using it. So actually, limit utilization is actually going down. And this is significant. Credit utilization going down. And that's basically a sign of maturity as far as consumers are concerned. But you're absolutely right. This is not just a credit story. This is a credit quality story. The share of insolvencies in the economy rising, clearly on a year-over-year rising by 20%, very strong, but you're absolutely right, from a very low base. So it's not really something that we should worry about at this point, but clearly the direction is up.
And this is interesting. We're seeing a move to proposals to creditors, which is a much less drastic process than consumer bankruptcy.
Absolutely. 80% now of all insolvencies are proposals. Now, proposals is a situation in which you sit down with your lender and you say, listen, let's do something about it. Let's compromise and get some payments here to make sure that I can cope with it, as opposed to complete bankruptcy. This is actually good for the lender and good for the borrower. So now 80%, a record high share of insolvencies are actually proposals, and it's something that is benefiting banks in terms of cutting their cost here, but also benefiting the consumer.
There's less legal, there are fewer legal fees, and obviously the handcuffs that get put on the consumer are less onerous. I mean, you can be denied credit for years or restricted credit for years if you go bankrupt.
Exactly, and we see more signs that this kind of arrangements or communication, if you wish, between lenders and borrowers. For example, if you look at the bucket of delinquency that moving from 30 days to 60 days, it's rising. Now, usually in a slowdown, when you move from 60 days to 90 days, it continues to rise. This time it's actually falling, which means that bankers, the lenders are able to stop the fire, go to the consumer and say, listen, you move from 30 to 60. Let's see what you can do. And that's something that is important because it, again, limits bankruptcies, slow it down, and leads to proposals. So I think it's a very healthy process that is helping both the lender and the borrower.
But there are some trends that should be watched, including an increasing share of subprime borrowers.
Absolutely, there is no question about it. Listen, you cannot have a situation in which everything is fine when interest rates went up from 25 basis points to 5% over the course of breakfast. Clearly, you will see the situation deteriorating, and that's just the beginning. It will continue to go up. The question is from what level and how high it's going to go up. Remember, the number one factor impacting delinquencies is what? The unemployment rate. And as we know, the labor market is still relatively strong. So yes, it's rising. I look at the line of credit delinquency rates among subprimers starting to rise. As you suggested, credit card delinquency is starting to rise, according to Equifax. So all those forces suggest that the direction is up, and that's not a big surprise. The only surprise is that it's not as high as we have seen in previous recessions, and the reason is clearly the labor market that is still very strong.
That's interesting. Yeah, I've heard that said, that once the labor market rolls over, watch out.
Absolutely. The labor market is the number one factor. So the hope and the prayer is that the Bank of Canada will start cutting interest rates before the unemployment rate goes to territories like 8% that in the past led to a significant increase in delinquency rates. We don't think that will happen. We don't think that the labor market will deteriorate in a very significant way. We see the Bank of Canada cutting starting in June, and the unemployment rate will not be very high at this point.
So you think, I mean, it'll be a courageous step, won't it, by the Bank of Canada to start cutting interest rates because inflation, it's like one of those wildfires that lurks under the soil in some ways.
Well, that's why it's not easy, but we have to remember one thing. The Canadian economy is basically operating at very close to 0% GDP growth. We are basically in a very, very, very soft landing scenario, if you wish, or a very mild recession. Whatever it is, it's not pretty. So the Bank of Canada is realizing that. The trajectory when it comes to inflation is very clear. We are going downward. And if you remove mortgage interest payments, it's actually, we are already at target. I think that we are getting slowly to where we need to be, and that's good news. So I suggest that overall, the Bank of Canada will have the courage to start cutting interest rates in June. The market was expecting them to cut in April, and that's, of course, not happening. I think that will be the first cut, and I think that's the right thing to do.
Just finally, Benjamin, I get the feeling, I don't have any numbers here, that there are far more sources of credit that have arisen in recent years, partly because of internet banking, new players coming in. So are there lots of new ways for people to borrow money compared to, say, a decade ago?
There is no question about it. There are many other more products, but also providers. And what we're starting to see more and more, especially in the mortgage market, is actually alternative lenders entering the market, especially mixed mortgage investment corporations. So the risk profile in the market is rising. Now, many of those mix are very well capitalized with good risk management. That to an extent that there is new entries to the market, less sophisticated lenders, that's a risky scenario. And that's something that we have to watch.